Good day, everyone. Welcome to Western Alliance Bancorporation's first quarter 2024 earnings call. You may also view the presentation today via webcast through the company's website at www.westernalliancebancorporation.com. I would now like to turn the call over to Miles Pondelik, Director of Investor Relations and Corporate Development. Please go ahead.
Thank you, and welcome to Western Alliance Bank's first quarter 2024 conference call. Our speakers today are Ken Vecchione, President and Chief Executive Officer, Dale Gibbons, Chief Financial Officer, and Tim Bruckner, our Chief Banking Officer for Regional Banking, will join for Q&A. Before I hand the call over to Ken, please note that today's presentation contains forward-looking statements which are subject to risks, uncertainties, and assumptions, except as required by law. The company does not undertake any obligation to update any forward-looking statements. For more complete discussion of the risks and uncertainties that could cause actual results to differ materially from any forward-looking statements, please refer to the company's SEC filings, including the Form 8-K filed yesterday, which are available on the company's website. Now, for opening remarks, I'd like to turn the call over to Ken Vecchione.
Good morning, everyone. I'll make some brief comments about our first quarter earnings before turning the call over to Dale. He will review the financial results in more detail. I'll come back and discuss the 24 outlook, and then Tim Bruckner, our Chief Banking Officer, will join us for Q&A. For the last 3 quarters, the mission of the company has been to reposition the balance sheet and optimize our funding structure to establish an unassailable foundation of higher capital, liquidity, and insured and collateralized deposits, and further distance us from last March. Together, these factors should provide a bulwark to better insulate the bank from future industry and market volatility, as well as support more predictable, superior long-term returns. This quarter, we generated exceptional deposit growth of $6.9 billion that accelerated our repositioning plans at a faster pace than anticipated. We reached our CET1 capital target of 11%, lowered our HFI loan-to-deposit ratio by 10 points to 81%, and increased our already leading insured deposit ratio to 81%. Our liquidity profile was also enhanced by a $6.5 billion increase in unencumbered securities and cash from year-end, which also allow us to pay down borrowings by $1 billion. In summary, our repositioning goals have largely been accomplished. I'm pleased that during the quarter of outsized liquidity growth, Western Alliance earned $1.72 per share, excluding the increased special assessment from the FDIC, and tangible book value continued to climb despite rate headwinds. Asset quality remained steady, with special mention loans and classified assets declining $139 million in aggregate from Q4. Net charge-offs remain low at only 8 basis points of average loans. Our excellent liquidity positions us to drive stronger loan growth starting in Q2. Loan growth should track proportionally with deposits to maintain our improved loan-to-deposit ratio and allow us to exit 2024 in line with market expectations. Dale will now take you through the financial results.
Thanks, Ken. During the first quarter, Western Alliance generated reported pre-provision net revenue of $247 million, net income of $177 million, and earnings per share of $1.60. Excluding the $18 million FDIC special assessment charge, PPNR was $265 million, net income $191 million, and earnings per share was $1.72. Net interest income increased $7 million from Q4 to $599 million from higher average earning asset balances, as well as lower average borrowings. Non-interest income of $130 million increased $39 million quarter over quarter from consistent performance in mortgage banking, including an improved MSR valuation from a higher balance of servicing rights owned. We look at mortgage revenue holistically because our conservative valuation process, when servicing rights are created, often results in understated MSR values, which dampen gain on sale revenue. GAAP non-interest expense was $482 million, or $464, excluding the FDIC special assessment. Deposit costs of $137 million were $6 million above Q4 levels, essentially offsetting the net interest income growth during the quarter, and driven by strong deposit growth from both existing and new clients in our HOA and Juris Banking businesses, along with the continued rebound in mortgage warehouse from seasonal lows. Typical seasonal factors, as well as the reset of incentive compensation accruals, which were discounted in 2023, were the primary reasons for the increase in salaries and employee benefits in Q1. Provision expense of $15 million resulted from loan growth as well as $9.8 million in net charge-offs, while our economic outlook remained stable. Lastly, our effective tax rate fell to 23.5% from a temporarily elevated rate last quarter. Loans held for investment grew $403 million to $50.7 billion, while deposits increased $6.9 billion to $62.2 billion at quarter end. As a result, our held for investment loan-to-deposit ratio fell to 81% from 91% last quarter. Outsized deposit growth accelerated our liquidity building efforts. Securities and cash increased $5.4 billion quarter over quarter and allowed for a further $1 billion reduction in borrowings. Finally, tangible book value per share expanded 58 cents for the quarter to $47.30 from retained earnings, which more than offset a modest rate-driven increase in our negative AOCI position. Held for investment loan growth of $403 million occurred predominantly in C&I categories. Commercial and industrial growth of $646 million demonstrated noteworthy progress in our regional commercial banking strategy, as well as success in both mortgage warehouse and tech and innovation. C&I growth also mitigated a purposeful reduction in commercial real estate. On a year-over-year basis, total loans increased $4.3 billion, almost entirely from C&I production, which has been a point of emphasis for the bank. Outstanding deposit growth of $6.9 billion resulted from broad-based growth and market share gains from our regions, commercial deposit businesses, and digital consumer channels. More specifically, our regions contributed approximately $1 billion, HOA and digital consumer each over $800 million, Juris Banking over $400 million, and Corporate Trust added $160 million. Mortgage warehouse deposits reacquired the $3.5 billion and fully replaced Q4 outflows as our DDA deposit balance at March 31st surpassed where we were at September 30th. Overall, in the more stable rate environment, we are experiencing minimal mix shift of existing client funds into higher cost deposits. Turning now to our net interest drivers, held for investment loan yields increased 12 basis points due to the higher rate environment. Loan growth was weighted toward the end of the quarter as demonstrated by period-end loan balances exceeding average balances by $1 billion. The yield on total securities decreased 33 basis points to 466 from our efforts to significantly enhance our liquidity profile, which resulted in total high-quality liquid securities increasing $4.8 billion from Q4. In addition, the proportion of average interest-earning assets invested in securities and cash increased 23% from 21% in the fourth quarter as a result of these repositioning efforts, which have largely been completed. These efforts position us well to deploy incremental funds into higher-yielding commercial loans earlier than initially expected, as well as to manage the cost of deposits lower ahead of Fed rate cuts. The cost of total interest-bearing deposits expanded 11 basis points, while the total cost of funds was flat at 282, as average short-term borrowings declined $1.8 billion to 8% of average interest-bearing liabilities. In aggregate, net interest income increased approximately $7 million, while net interest margin of 360 compressed 5 basis points due to the earning asset mix shift in securities we discussed. Additionally, adjusting for the increased FDIC special assessment and deposit costs, our adjusted efficiency ratio for the quarter was 54.4%, which also reflected higher seasonal costs. Deposit costs moved up only $6 million, or 4.6% quarter over quarter, even though average balances of ECR-related deposits grew $1.4 billion, or 7%. Asset quality metrics continue to remain steady and are reflective of our ongoing forward-looking portfolio monitoring and proactive credit mitigation strategy, which produced low realized losses. In aggregate, special mention loans and classified assets declined $139 million from Q4. Non-performing assets increased $126 million to $407 million, or 53 basis points of total assets, as we execute our strategy to accelerate resolution for this subset of loans and proactively address them before reaching maturity. Notably, about two-thirds of our NPLs are paying as agreed with regard to debt service obligations. As stated previously, we've largely avoided the largest urban centers for commercial real estate lending that have experienced more value contraction than the nation at large. we see that in our submarkets, which we watch closely, our borrowers' projections continue to perform better with more stable appraisals than other markets. Quarterly net loan charge-offs were $9.8 million, or 8 basis points of average loans. Provision expense of $15.2 million covered net charge-offs and provided reserves in concert with loan growth. Our allowance for funded loans increased $4 million from the prior quarter to $340 million, and the allowance for credit loss ratio to funded loans of 74 basis points was stable, covering 94% of non-performing loans. The valuation of NPLs, which primarily consist of real estate secured credits, are confirmed by fair value appraisals of collateral. Our CET1 ratio again grew 20 points to 11%, or 10% when adjusted for our negative AOCI position, which is 160 basis points higher year over year and 230 basis points above our Q3 2022 level when our repositioning efforts began. Our tangible common equity to total assets ratio moved down approximately 50 basis points from Q4 to 6.8% as asset growth in low-risk categories exceeded organic capital accretion from higher earnings. Tangible book value per share increased 58 cents from December 31st to 47.30 from retained earnings growth outpacing the higher AOCI offset. Our consistent upward trajectory in tangible book value per share has outpaced peers by over 4 times since 2013, including strong growth in 2023. And I'll hand the call back to Ken.
Okay, thanks, Dale. We have transformed the bank several times in the company's history, starting as a Las Vegas bank in 1994 and expanding into Arizona and California in 2003. In 2010, after the GFC, during which we were landlocked in some of the most stressed markets nationally, we began our diversification strategy into national business lines with HOA and mortgage warehouse that created diversity, growth, and sustainable earnings without undue risk. In 2015 and 2016, we added Bridge Bank to enter into the tech and innovation economy, and then purchased the hotel franchise finance business, which provided expertise and deep industry knowledge, enabling us to become a leader in that vertical. In 2018 and 19, the bank entered, developed, and launched 3 specialty deposit verticals: settlement services, business escrow services, and corporate trust that expanded business diversification strategy and produced access to new deposit sources. In 2023, we launched the digital consumer deposit strategy to gain access to a granular deposit base. Now, in 2024, the company has worked hard to reposition and fortify its balance sheet and liquidity. Informed by the events of last March, the management team continues to optimize funding, significantly improve capital, and carry higher levels of insured and collateralized deposits to form a solid, sturdy balance sheet, which can be used as the foundation to reignite earnings, grow the balance sheet, and generate organic capital while ensuring asset quality remains safe and protected. So what does WAL look like in the future? Well, using and reinforcing the disciplines I just mentioned, Western Alliance has and will continue to add risk management architecture that will enhance the company's guardrails as we continue to develop new organic avenues for growth to deliver consistent upper teens return on tangible common equity and sustainable earnings growth that maintains historical capital accumulation at multiples higher than other banks. We are excited that the repositioning strategy has been largely completed. We have fortified our balance sheet, which will allow the company to generate earnings velocity through the back half of 2024 and into 2025. To that end, from our first quarter results, we update our 2024 guidance as follows. Continued thoughtful balance sheet growth at a slightly higher level, building on the momentum of Q1, and more focus on deploying incremental liquidity into sound, safe, and thoughtful loans. Our current loan-to-deposit ratio provides flexibility to selectively make more loans as opportunities arise. For the full year, loans are expected to grow $4 billion, up from $2 billion, given the new client wins in current pipelines. We also expect deposits to end the year up $11 billion, which is $3 billion above our previous consensus. Turning to capital, we expect our CET1 ratio to remain steady at or near 11%, capturing the forecasted increase in loan volume. Regarding net interest income, we reaffirm our 5 to 10% growth expectation from Q4 2023's annualized jumping off point and are tracking to the upper end of this range. Our rate outlook includes 2 25 basis point cuts in the back half of the year. In a higher for longer rate environment, without rate cuts by the FRB, we would expect NIM to incrementally benefit by mid-single-digit basis points from loans repricing in an elevated rate environment. Our expectation is that net interest margin will trough in Q2, but the full quarter effect of our liquidity build, with the full effect of our liquidity build, while net interest income will continue to move higher from Q1 levels. NIM should ascend due to repricing of existing loans and new loan originations, which all in should generate a full year NIM in the low 350s. Non-interest income should increase 10 to 20% from an adjusted 2023 baseline level of $397 million. Mortgage banking related income remains somewhat dependent on the rate environment and mortgage volume, but we are encouraged by the resilience of the Q1 results. Non-interest expense, inclusive of ECR-related deposit costs, is now expected to rise 6 to 9% from an annualized adjusted Q4 baseline of $1.74 billion, primarily from the accelerated ECR-related deposit growth we achieved in Q1, which helped the company reach liquidity targets earlier than expected. In aggregate, these factors should enable Western Alliance to consistently grow PPNR throughout the year and establish a higher baseline headed into 2025. Asset quality continues to remain steady and is performing as expected with continued sponsor support of projects. Our full year net charge-off guidance remains 10 to 15 basis points of average loans. At this time, Dale, Tim, and I look forward to answering your questions.
We will now begin the question and answer session. If you would like to ask a question, please press star 1 on your telephone keypad. If for any reason you would like to remove your question or your question has been answered, please press star 2. If you are using a speakerphone, please pick up your handset before asking your question. The first question comes from the line of Jared Shaw with Barclays. Jared, please go ahead.
Hey, good morning, guys.
Morning.
Just looking at looking at the guidance with the expense growth primarily coming from the ECR, I guess why wouldn't that also help drive a higher expectation for NII? You're saying, looking at the higher end of that, but if with this big deposit growth and the opportunity for loan growth, I guess are we giving up all of that spread early stages to the ECR?
No, it will help drive NII. The issue is that growth came in kind of ratably over the first quarter. We haven't genned up to the degree we can the origination of good quality credit to disperse those additional funds. That's going to take a process within, say, the second quarter. So it will catch up, but the second quarter is a little bit of a pivot point whereby we're going to look for, higher asset growth than we had in Q1, and that's going to hold that the second quarter back a bit.
The prior guide, let me just add, the prior guide included 4 rate cuts, which have now been revised to 2 cuts. To offset that, we've also increased our loan growth from $500 million a quarter to $1 billion a quarter. And that's what helps our net interest income throughout the rest of the year continue to grow quarter to quarter.
Okay. All right. Thanks for that. I guess maybe shifting a little to the capital and now that you're at the target floor of 11%, how should we be thinking about the desire to grow that from here? And can you give an update on how the credit-linked notes impact that going forward and sort of the timing on that?
Yeah, so we see capital remaining modestly at or above 11% for the remainder of the year. Increasing loan growth above trend will absorb the excess capital formation for the rest of the year. I will note that since we started our repositioning strategy on capital from Q3 of 2023, we've increased the CET1 ratio 230 basis points without raising capital. We do have a couple of CLNs embedded into these numbers, and the runoff of the CLNs is very modest year over year.
Yeah, as you recall, we collapsed two of our CLNs last year, in mortgage warehouse and capital call. We've got a few residentials that don't have substitution, credits in them, so they are just running off. We're gaining about 40 to 50 basis points in CET1 from that.
Thank you. The next question comes from the line of Casey Haire with Jefferies. Casey, please go ahead.
Great, thanks. Good morning, guys. Question on the loan and deposit growth. Just wondering how you guys got to those numbers. I mean, you guys have demonstrated that you're capable of putting up stronger growth than that. And just wondering if it's conservative or if you're just looking to manage the growth and have an eye on obviously the $100 billion line. So just some color there.
Yeah. So Casey, while we continue to remain cautious about the future economic activity, and we have de-emphasized certain asset classes, we do believe that we can actively grow loans $1 billion per quarter. And we feel rather comfortable with that based on the pipelines that get reviewed on a weekly basis. So we are de-emphasizing certain areas, as you would expect: CRE office, residential, general construction, a little cautious on multifamily. But we see better opportunities in warehouse lending group, MSR lending. The regional C&I business is beginning to take hold. Resort lending and maybe lot banking also give us the best risk-reward dynamics on the loan side. So if we could do better than $1 billion, we will, as long as it's safe, sound, and thoughtful growth, and the economic environment hasn't changed. But right now, we feel comfortable with $1 billion. As it relates to the deposit guide, we certainly had a monster quarter at $6.9 billion. A lot of that came in because of our better service levels, and we had a number of market share wins, as well as a number of our new deposit verticals have really begun to take hold. Settlement service had a good quarter. Corporate trust is growing. HOA had its best quarter ever. It was monstrous, okay? And in fact, we think we are now the leader in HOA deposits in the industry. And then the region also had a very good quarter as well for $1 billion. So taking together all that informs us that we think we're comfortable growing deposits $2 billion a quarter for the rest of the year. I will say, and it's something we're proud of here, when you look back over a year, we've grown total deposits by $14.3 billion. If you take out $1 billion for broker deposits, we grew $13 billion in a year. And that kind of gives us the confidence level to say that $2 billion seems very reasonable and practical.
Yep. Okay. And then just switching to the expense front, just to clarify, does the expense guide, do we include the $17 million FDIC assessment for this year? And then, if I layer in your guide, it looks like it's delivering an efficiency ratio in the low 60s. That's obviously with the deposit costs, but it's obviously running a little bit higher than what you've been guiding to in the past. I think it's been around 50%. So just wondering, what's the new expectation on that front?
Yeah. I would look for something in kind of the mid-50s. We were 54, for the first quarter, as you saw there. There was some seasonality in costs, which we talked about a little bit, primarily related to compensation and FICA. But we do believe that we can get that number back to beginning with a 4 again. But we would hope to have better performance, even though it was much stronger, from AmeriHome in that process. We do think that there's a significant kind of pent-up demand with AmeriHome, and that there's a lot of people that do want to move out of their house, but they're in love with their mortgage rate presently. When we had that dip down at the FOMC, commentary after the CPI in January, that it really kind of came back, and we saw a lot more activity. You saw that in our numbers. So with that on the denominator side, more steady situation on the numerator side regarding our ECRs, we think that number can trail down over time, but for now I keep it in the mid-50s.
Casey, on the FDIC special assessment, that's not in our numbers on our guide, and our adjusted efficiency is going to be in the low 50s as we work that down towards the high 40s. But that's what I would say. Okay?
Great, thank you.
Thank you. The next question comes from the line of Steven Alexopoulos with JP Morgan. Steven, please go ahead.
Hi, everybody. I want to start...
Steve, can you get a little closer to the phone? You're coming in muted.
Yeah, could you hear me now?
Much better, thank you.
Okay. So let me start on the deposit side. Ken, I thought you said you thought you could grow deposits $2 billion per quarter. Is that right? Because that would take you above the $11 billion for the year.
Well, on average, $2 billion a quarter, but Q4 is a little softer, as you've seen last quarter, where the warehouse lending deposits roll out. So we think that's more of a practical guide. Basically, we're just trying to tell you, think about the end number of $11 billion is where we think we'll end up.
Got it. Okay. And it's funny, Ken, I've asked you, I don't know, maybe 2 or 3 calls in a row. Once you get to your targets, how should we think about Western Alliance and growth, desire, appetite, where you could be long term? So if we think about, if we average this out, you'll probably $1.3 billion per quarter loans and deposits run rate. So call it $5 billion per year for each. Is that about, adjusting for the loan to deposit ratio, is that how we should think about this now that you're at target? Maybe that $5 billion-ish growth per year balance sheet?
So we've got a number of levers to pull, and we have a great deal of optionality. So first thing I'd say is, and the way we're thinking about it is, from here, whatever liquidity we bring in, whatever deposit growth we bring in, we would like to put out at about 80% loan to deposit ratio. So we could stay between that 80 and 85% level. And that's what we're going to try to target going forward. It'll take a little time to build up that loan growth engine, because obviously, if we're telling you $2 billion in deposits and $1 billion in loans, that's not 80%. But we're getting that back up again. You've got to get the deals done. You've got to get them documented. You've got to have clients put their cash in before we put our funding in, and that will just build up as we go throughout 2024 and into 2025. And then, if we do better than that, meaning a higher deposits or the loans stay in that billion-plus range, then we'll use some of that incremental liquidity and we'll use it to pay down borrowings. And that will also mute the growth of the balance sheet. Dale, you want to add anything to that?
Yeah, so stated another way, I expect that we can exceed those numbers, Steve, a bit, because we'll be paying down borrowings coincident with growing deposits faster than your $5 billion a year number.
Thank you. The next question comes from the line of Chris McGratty with KBW. Chris, please go ahead.
Oh, great. Good morning. Ken and Dale, it feels like the $100 billion's obviously got a ton of attention. It feels like you've more or less addressed every piece of it. Obviously, there's ongoing regulation, but liquidity, expenses, capital. Is that the message you're trying to send with the last actions of the last few quarters?
Yeah, so we are taking actions today and preparing to cross over $100 billion in a few years, okay? The improvements we've made in our risk management architecture, both on capital analysis, liquidity analysis, and planning, indicated to us that it was better to build that liquidity reservoir early on, and we wanted to get that done, and we've accomplished that. The other thing was, let's get capital out of the way, and we think 11%, around that number, is the right number going forward. So we've done all that. But behind the scenes also, Chris, is a lot more risk management build that has to occur. That's been basically built into the company over the last couple of years. So where we are today, we'll say we're about 75% of the way towards being ready to be $100 billion. $100 billion is just a number for us. We're not looking to get there sooner. It will all depend on, again, the economy and the opportunities that we have in front of us. But what we don't want to happen is we don't want to be stopped when we hit that level. So we want to grow in an unencumbered way. In the meantime, the risk architecture that we're putting into the company is paying dividends. It does have a return in how we think and manage the company. So we're happy that we're doing that as well.
Okay, great. Thank you.
Thank you. The next question comes from the line of Bernard von Gizycki with Deutsche Bank. Your line is now open.
Hi, good morning. So you guys had a nice quarter with fees, but you didn't change the full year non-interest income guide outlook. You noted mortgage will be dependent on rates, but you were encouraged by the resilient results. How should we think about maybe the seasonality after 1Q for the different fee lines for the rest of the year? Additionally, equity investments have picked up the past 2 quarters. Wondering if you could provide any color there and how you think it should trend for the rest of the year.
So there are a couple of questions inside of that. I'll take a shot at it, and Dale will fill in if I miss anything. But a good portion of the fee income comes from mortgage. I would say that mortgage hangs around the hoop for the next couple of quarters, similar to that of Q1. And of course, Q4 for mortgage is always lighter because of seasonal reasons. The gains you mentioned on the warrants, that's very consistent with the prior quarter. It consists of valuing over 500 positions every quarter. And as the tech business grows, we expect there to be more positions to be valued. And right now, we don't see a retracement in value at this time. And we think the way we're valuing it based on where the tech industry is, we're valuing it at the lower point of the cycle. Yeah, would you add anything?
Yeah, just a couple things. So other seasonality implications. So HOA, their best quarter is Q1, and that helped contributed to our nearly $7 billion increase there, as well as the recovery in kind of mortgage warehouse deposits. So I would expect that future quarters are going to be lower than what we put out in the first quarter. And in terms of our guidance, we are tracking toward the upper end of our guide that's in the book regarding net interest income. And frankly, we're a little above the midpoint for non-interest income as well.
Okay, got it. And Dale, I think you noted earlier that you don't expect much deposit mix shift from here. Obviously, the quarter was great with the amount of deposits you brought in, but the mix shift was obviously favorable, mostly the non-interest bearing, and then obviously in the interest bearing, there's less focus on the higher cost CDs. When you think about the rest of the year, you kind of said the minimal mix. Where are you kind of thinking for the additional $4 billion? Would it be kind of similar as we kind of look at to the outside quarters?
Well, if I put on my optimistic hat, I mean, we're really doing some creative things in the regions, which would be a primary source of where we might get non-interest-bearing deposits. And I would hope that we could actually show growth there. We certainly saw growth in the first quarter, and we're looking for that to continue. Maybe the trend you alluded to, in terms of CDs, I think that is going to continue to taper off as we run through 2024. And of course, the preponderance of the growth is going to come in money market.
Thank you. The next question comes from the line of Ben Gerlinger with Citi. Your line is now open.
Hey, good morning, guys. Sorry about any background noise. I had to step out. I just had a quick question in terms of the ECR. I know you guys lowered it, the cut expectations to kind of 2 in the latter half of this year. But just kind of thinking philosophically, if we have 2 more in the early part of next year, so a total of 4, just kind of pushed it out 6 months, do you think next year's expenses could actually be flat, if not down?
Yeah, I think that could certainly be the case. Also would probably help with revenue significantly on AmeriHome as we discussed as well.
Yeah, said another way, we were talking about this earlier. I was going to say, any future rate cuts into 2025 will help fund any inflation we have in the base, and I think that's what you're suggesting.
Just one more point, getting to Ken's comment earlier about optionality, one thing that this, pool of liquidity gives us to enable us to do is to really one-off some of our higher cost ECRs now, which we're undertaking to push them down, and so we can get in front of, FOMC action with lower funding costs. You saw that a little bit in Q4 to Q3, where the average ECR actually declined slightly. We'd like to see more of that, of course.
Gotcha, that's great. And it's nice to see WAL get back to the kind of the powerhouse that it used to be in terms of growth potential. Kind of with that, though, have you guys thought about any sort of potential M&A? Not necessarily get over 100, but just bolt-on technology or any kind of fintechs, just any sort of capital deployment outside of the share purchase?
So it's still for us a little premature to think about M&A, and I would say, given the prospects that we see in front of us, we'd like to take any excess capital that we have and put it into organic growth. We think that would serve us best.
Thank you. The next question comes from the line of Matthew Clark with Piper Sandler. Matthew, please go ahead.
Hey, thanks. Good morning, everyone. On your interest-bearing deposit costs, I mean, they were up 11 bits this quarter. I think the prior quarter up 7. Can you give us a spot rate on interest-bearing deposits, and what's your outlook there? Is it fair to assume that rate of change will start to slow here and maybe stabilize next quarter or two?
Yeah, we're looking at really kind of stability across the board, both on asset repricing and on kind of liabilities here. There hasn't been, since it's obviously been since last September, kind of the last kind of rate changes we were talking about in July. It's really kind of tapered off, and the volatility is very stable. As I mentioned earlier, I think you see that net interest income going up, approximately the same amount as earnings credit costs rose. So there's no great disparities between spot rates and kind of average rates presently.
Well, what I'd add is that while deposit costs went up, we got rid of $1 billion in borrowings, and our overall cost of funds stayed flat quarter to quarter. So when you think about what happened for the quarter relative to net interest margin, our loan yields went up 12 basis points, our deposit costs went up 11, we paid down debt, and really the bottom line here is the margin dropped a little bit because of the excess liquidity we brought in that we're keeping on the balance sheet in cash and in investment securities.
Yep, got it. Okay, and then just last one for me, the uptick in classified assets and non-performers. Can you just speak to what drove those increases and kind of the plan for resolution there?
Yeah, sure. Tim Bruckner, I'll take that. So first, I'll just say the majority is related to secured investor real estate loans. This really results as a function of how we manage our portfolio. So as we've taken every opportunity to tell all of our constituents, we press hard for remargining and have since early in the rate increase cycle. That drives to resolution. So the classified loans will move up as we reach the endpoint of a negotiation that doesn't result in an effective remargin. We then take those loans and we ledger the balance appropriately based on the value of the asset. We apply all principal and interest payments received to reduce that loan balance. And I think it's important to note on our books that 2/3 of these are current in terms of payments being made. So we're not waiting for a delinquency to take our action here.
And all the ones we moved in this quarter were all paying.
Correct, Ken,
as well.
thank you.
Thank you. The next question comes from the line of Timur Braziler with Wells Fargo. Your line is now open.
Hi, thanks for maybe just following up on that last line of questioning. Can you just talk us through the interplay between non-performing loan migration and the allowance? I guess I was a little surprised to see NPLs move higher while overall allowance level is pretty much flat quarter on quarter.
Sure. Tim again. I think it's important to note in this context that the majority, we have a very small charge-off every quarter. The majority of the charge that we took this quarter was really associated with adjusting the balances of those loans as they migrate so that we have plenty of coverage based on current appraised value of the asset less the cost of liquidity. So we move fairly aggressively into non-performing. We adjust our balance as opposed to placing just reserves on that.
Okay, so
Again,
just the migration itself doesn't necessarily. What was that?
Absolutely right. And so when we talk about our philosophy here, we're a low loan-to-cost lender. When you look at office, underwritten office, 58, 59% is where we're at. So we look at this in the economy of credit underwriting, collateral, and our collateral position creates character, it creates support from sponsorship, and that's what we see demonstrated. So it carries through that we typically have very low loan to carrying values throughout the entire throughout the process. Where we get close, we make an adjustment, take a charge, and stay in balance.
Yeah, our charge-off rate for the quarter annualized was 8 basis points, which is only about maybe a fifth or a fourth of what the industry is. Meanwhile, our reserve level at 74 basis points, in the appendix of the earnings release, we walk that up to the 130 level, considering the things that we have that we do that others don't do, like a higher levels of residential real estate, as well as CLNs we talked about a little bit. And so we think that's actually a pretty strong level at 74 basis points. So if you take 8 basis points into 74, you've got 9 years of loss coverage within there, while our duration of our loan book is under 4.
Yeah, I'd add more than anything, when we look at this category, it's performing as expected and moving to resolution as expected.
Okay, and then maybe as my follow-up, just looking at the securities purchases this quarter, can you give us the average just to get a sense of what that blended effect will look like in 2Q?
We didn't hear that clearly enough.
For the securities purchases made during the quarter, just trying to get a sense of what the rate was on those purchases to get an idea of what the blended rate in the second quarter will look like.
Yeah, so the rate that we have on average for the quarter, which you saw that down 33 basis points to the 460s, that should be fairly consistent with what's been done. The purchases that were done were fairly short term. Expect to maybe roll out of some of that and keep maybe more at the Federal Reserve as well. So that's probably a little bit of stronger profile.
Thank you. The next question comes from the line of David Smith with Autonomous Research. Your line is now open.
Could you just confirm what you think your true asset sensitivity is today? You know, the 10K said that a 100 basis point higher shock would boost NII by 3%, and I thought I heard you saying earlier that the NII guide is towards the high end, but the better loan growth is being offset by there being 2 fewer cuts in the model, which would imply liability sensitivity. So if you could just expand on that. I know that NII is just one piece for you with the deposit costs and the mortgage income benefiting from lower rates, but just strictly for the NII, like how you really impacted by higher or lower Fed today?
Yeah, correct. I mean, NII is going to be increasing in a higher rate environment, and you saw that a little bit here, even though it's sort of stable. I'm going to call it a stable environment. We did have a bit of a slope upward in yields as net interest income was up $7 million. What's changed though is that we're really looking more at what we call earnings at risk. So it considers the NII, it considers the ECRs, and then it also considers what might happen in the AmeriHome context. And if I put all those together, we would prefer a lower rate environment rather than higher because of kind of the additional leverage pickup we would get with AmeriHome in particular. But yes, NII solely would still increase in a rising rate environment and decline in a lower one.
Okay. And then just in terms of the NII guide staying the same, although maybe moving to the higher end of the range, how that works with there being fewer cuts and the better outlook for loan growth?
Yeah, I mean, it's up. Yeah, I mean, it's if fewer rate cuts, that results in a higher number because we're not going to get the compression on the way down, and then kind of the volume element we kind of talked about as we deploy, the $7 billion in deposits that we got in Q1 and what were the additional at least $4 billion that we're looking for the rest of the year into, at least on a prospective basis, into higher yielding assets rather than into kind of short-term securities that satisfy high quality liquid asset requirements.
It will build quarter to quarter with a slight improvement in Q2 as we put the loans out, and then it begins to grow stronger in Q3 and Q4.
Thank you. The next question comes from the line of Brandon King with Truist Securities. Brandon, please go ahead.
Hey, so I understand NIM is supposed to trough in the second quarter, just given the HQA build at the end of the first quarter. But could you quantify particularly how much NIM compression you're expecting for the second quarter?
Yeah, so we dipped down 5 in Q1 from Q4. You saw that. I think that we can dip down another 10 on higher volumes.
Okay, and then the expectation is that as you throughout the second half of the year, if rates stay, I guess, stable from here, that mid-single digit expansion quarter over quarter. That's correct, right?
Yeah, we would look for it to increase because the marginal spread that we're going to pick up between deposits and loans. Say we're lending out at 80% of the increase in deposits. That's going to be accretive to the margin overall.
Thank you. The next question comes from the line of Gary Tenner with D.A. Davidson. Your line is now open.
Thanks. Good morning. I had another follow-up on the credit side of things. If I look at the total classified increase, a little over $100 million in the quarter, the investor CRE side, inclusive of lower hotel and an increase in office was basically flat, but the delta was a little more on the C&I side. So I just wonder if you could, comment about within the C&I book what you're experiencing. There were any, particular business lines that were weaker and got more movement this quarter.
Sure, thanks. Tim again. Okay, our portfolio it remains stable. We remain vigilant in this elevated interest rate environment, but we're really seeing stable performance across all the segments. Outside of the more pronounced movements that we've talked about in office, really any other movements that we see are idiosyncratic and related to a specific business, not a trend in a portfolio.
All right, thank you, Tim. And then just one question on the income statement, the service charge line down by about half versus the fourth quarter and kind of where it had run previous to that. you remind us what happened there and thoughts going forward?
Yeah, we've had elevated service charges here for a little bit. They came down in Q1. I think they're going to remain lower until we, have, more follow-on execution of some things we're doing in service charges in basically the regions.
Thank you. The next question comes from the line of Jon Arfstrom with RBC. John, please go ahead.
Thanks. Good morning. Couple quick ones here. Dale, you used the term on the mortgage-related deposits that you reacquired $3.5 billion. That was a big chunk of the growth. What do you mean by that? And are you kind of signaling that deposits flatten out or maybe decline a bit in Q2? Just so we understand that.
Well, what I mean is that so the mortgage warehouse deposits primarily come from two sources. One is principal and interest, and those are on a monthly cycle as we get funds in, from mortgage payments, and then we remit them to the GSEs, some 3 weeks later. And so you get this kind of intra-month kind of sine wave. Regarding the taxes and insurance, though, that's a longer cycle, and particularly, I think taxes are usually semi-annual, some are annual, and so we have a dip from tax payments, property taxes, in those deposits, and it's very pronounced in the fourth quarter. That's what really drove that number lower from where we were at September 30th. And so we say reacquired in terms of those funds are then depleted as they're paid to the taxing agencies, and then they start building up again, and they built up, quickly. And frankly, we brought in, some other clients there too, which kind of helped to goose it up because normally it wouldn't have recovered quite that quickly. You'd have to be in the second quarter to do it, but that didn't happen.
Well, and out in Q4 came back in Q1, John, a little stronger than we thought because we had some market share wins at the end of last year that began to fund up in Q1, and that's what Dale means.
Yep. Okay. Thanks on that. It's just bigger than I thought, and that helps me understand that. Ken, you mentioned very early in your prepared comments an upper teen return on tangible as your goal. How do you view the sustainability of that? I mean, if you can do that, the stock goes up, but is that the key metric you look at, and what do you think about sustainability of that longer term?
Yeah, well, we wouldn't have put it in there if we didn't think that we had a high confidence level of getting there. It'll build up through 2024. And again, everything we talked about on the last earnings call and this one is about the earnings exit or velocity rate out of 24 into 2025. Now, that return could actually spike up in the event that the Fed does take some more actions and reduces rates, and then you'll see a greater share of fee income come from AmeriHome. Right now, we kind of have that at a basic steady state of where it is today. But rates come down, say 100 basis points over the next 4 quarters or whatever, you can see AmeriHome really gearing up and producing far more income and generating a higher return on equity for the entire company.
Thank you. The next question comes from the line of Erik Zwick with Hovde Group. Your line is now open.
Good morning, everyone. A quick follow-up question, maybe kind of a multi-part question regarding your loans that are secured by real estate collateral. First, I'm just curious, how often are the individual property valuations refreshed, and what percentage of your portfolio has received updated valuation, say, in the past 6 months? And, the reason I guess I'm asking is that CRE transaction volume has, in certain markets, has been somewhat muted in recent quarters, and that can potentially obscure or slow market recognition of changes in values in either direction, right, up or down. But with current concerns that higher rates have put pressure on values, like how comfortable are you that the valuations you're currently using and reserving against are reflective of current market valuations?
Sure, thanks. That's a good question. I'll take it. Tim again. Okay, so a couple of things just to level set. we're a bridge and construction lender in commercial real estate. Okay, so there isn't a scenario here where we have term loans that we're waiting for maturity to look at, or that are benefiting from a long-term fixed rate that was put in place in a different environment. These are floating rate loans, and we value them against appraisal and performance on an ongoing basis. All of our documentation includes terms for reappraisal and remargin. So those thoughts around value are critical to us, and that isn't something that we wait for a default or a maturity to handle. Additionally, we have substantial sub-market data that we track to track trends in value, but in advance of that, we're tracking the trends in sub-market occupancy so that we can really understand how that will translate to a value in situations when there's limited market sale activity.
Thanks, Tim. I appreciate your color. That's all for me today.
Thank you.
Thank you.
The final question comes from the line of Zach Westerlind with UBS. Zach, please go ahead.
Hi, just a quick follow-up on the ECRs. Dale, I know you said that you guys are trying to get ahead of those kind of higher cost accounts. Do you think that the beta on the ECR rate on the way down when the Fed starts cutting, do you think that could be equal to or exceed the beta that we saw on the way up?
You know, I mean, you have to kind of, segment that into, what types of ECRs there are. Within the mortgage warehouse side, yes, I think we're going to be at or near 100%, perhaps even over 100% for some clients. But in total, it'll be lower than that as we use ECRs for HOA deposits as well. But those start at a much lower rate to begin with. So I do think that we'll be at least as fast as we were on the way up, on the way down, and maybe in some cases even a bit better.
Understood. Thank you.
Thank you.
Thank you.
I would now like to hand the call over to Ken Vecchione for closing remarks.
Thanks, everyone. Look, we think we had a good quarter. We're very pleased with the balance sheet repositioning, as we stated, and we look forward to the next call to tell you more about our progress. Thanks again for spending some time with us today.
This concludes today's conference call. Thank you for your participation.